right. Great. So here we are with Lasse Clausen from 1KX. I'm so excited to have you in this week's podcast. Thanks so much for joining me.
Thank you very much for having me.
Great. So first off, obviously we'll get to your investment thesis and all the interesting trends that you're seeing in DeFi and crypto at 1KX. But I'd love to just start with you first. Can you tell me about your background and what got you interested in crypto?
Yeah, so I was a software entrepreneur in Berlin, and I was doing mobile internet startups and was, or still are, just a product nerd. And so on a Sunday in 2012, I wanted to know what it's like to pay with a mobile phone. And at that time, the only way to do that was either in Japan or I think South Korea, and I had seen it years before in Japan. But there wasn't, PayPal didn't have an app yet, and really Bitcoin was the only way to do that. And then we actually in Berlin had the first place in the world to pay with Bitcoin. The Room 77 Burger Bar, started by this libertarian Texan. And so I kind of had the fortune that it was relatively easy for me to try this out. And I came from a sort of a product manager perspective. I wanted to really know what is the user experience of paying with a mobile phone. And spent a couple of Bitcoin on a burger and fries. And it was actually, so what's interesting also about this place is that it really was that early that there wasn't even a mobile wallet before. And so people would come with their laptop and type the public key manually in. So really enthusiastic, very, very early Bitcoin people. And then at that time, when I tried it out, there was already the first mobile Bitcoin wallet of the world actually was built in Berlin for that. And it was a great, it was great. You scanned the QR code, you punched in your PIN, paid. Bitcoin was fast and cheap as a payment back then. And I thought, oh, this is great, but I don't see them winning sort of mainstream adoption. And this is because something that we as entrepreneurs at those times, with apps of millions of users, really understood how difficult it is to get something in the hands of millions of users, but then to understand maybe just another tap might be too difficult and too challenging. And setting up backing up your private keys and all these things was just something I didn't see happening. And on top of that, payment networks are even more difficult because first you need to convert like 80-90% merchants.
Right.
That for me in Berlin, I bother with like downloading just another app, so I can pay. And I think, and we actually have two projects in our portfolio that are doing a terrific job at, converting Starbucks and other companies to use our payment network. But I didn't see the Bitcoin Core guys doing, that we're not going to wine and dine Starbucks.
Right.
And I think we can still see that Bitcoin itself is sort of struggling as a payment network. And, back then that was the narrative of Bitcoin. That was a peer-to-peer cash. And so I thought it was great, but I didn't see it winning. And so I kind of had these useless Bitcoin on my phone left. And then I, at a dinner in Berlin in the end of 2013, I met Amir Taki. You might know him.
Yes.
And I think from him and some other folks heard about Ethereum. And that really resonated with me simply because of the FAT protocol thesis, right? So the idea is that in venture, you had to be really smart and be able to predict an individual application that would be successful. And I, as an entrepreneur, had really witnessed that nobody really can predict innovation. And on average, VCs actually lose money. And so what resonated with me is that I don't even need to know what's going to win on the application layer. If I invest in Ethereum, and then decentralized insurance or maybe decentralized money or whatever it is, become successful on top of Ethereum, then I sort of will participate in that upside.
Right.
And so this is something what I learned in when you're young, you don't necessarily, or at least I didn't get this, but it's actually really nice to put yourself in a position where you can be pretty stupid and still be successful. And this seemed like a very good way to do that.
You just need to have the platform win, and eventually you're betting that one of the many different applications on top of this platform will become successful. And so,
right? And this wasn't before with the internet. the way to do that was only with you bought a lot of domain names. That was kind of the only way that you could sort of index-wise invest in the Internet of Information. And with blockchains, the unique thing is that protocols are investable, and you can, again, just broadly bet on the Internet of Value or the Internet of Money is going to be a thing, and then invest in the protocols that are most likely going to get the most developer adoption.
Right.
Anyway, so that was kind of the background, and then I was sort of actively watching crypto evolve because I knew about timing, and continued doing mobile internet companies. And then end of 2016, we had another hype cycle starting to form, and my CTO and co-founder of two companies, Christopher, we thought maybe it is time actually now that we as application layer entrepreneurs can build on top of blockchain. Realized it was a little bit early, but this is sort of when we, kind of refreshed our understanding of DeFi protocol thesis and more things, which led us to formulate our thesis. Got us really, really excited about participating in the space. No matter any way we can move it forward, we saw the best way to do that at that point was by being an investor.
Got it. And so, but you had already invested in Ethereum before this point?
Yes.
Or bought Ether, I guess.
Yeah, just bought Ether in the ICO. Never touched the wallet until 2017. And
oh, that's nice. And so, okay, so at this point, 2016, you decided to become a dedicated investor in this space and move on from building applications.
Yes.
Okay.
So what we saw is that I think when you've been an entrepreneur, it is substantially easier to be helpful to other founders than when you haven't been. I just think being an entrepreneur is actually exceptionally difficult. It's really a pretty difficult life, and it seems kind of glamorous and exciting from the outside, but 95% of the moments of an entrepreneur are really difficult. And we had one VC that had backed us as entrepreneurs that gave us the sense that he's always got our back. Right? And when you're having sleepless nights and some sort of existential anxiety about your company, I think it's extremely helpful and comforting to have the sense that there's at least some people out there that are they're going to go through this with you no matter what. And sort of that was our inspiration as investors, and also looking at the space, especially in 2017, the average quality of investors was just it was what it was, but it wasn't fantastic. And so we really saw a wide gap of investors that are entrepreneurs themselves, that understand technology, but that also understand this new paradigm. Because on top of that, what we saw back then is that a lot of very successful traditional VC funds had a really hard time wrapping their heads around this completely new paradigm.
Okay, and then, so is this, let me stop you there. Is this when you founded 1KX, or did 1KX come later, or was this a different fund?
So 1KX started in early 2018. So we were, just invested the private Ether windfalls, and then had some, some folks in adjacent spaces reach out to us and proposing that we start a fund and that we take outside capital. Namely, Passport Capital was sort of the one that persuaded us the most and helped us a lot with setting up the fund structure. I think at that time there was still a lot of confusion about how you best structure these things. Is it a hedge fund? But it shouldn't be, because it's you're not trading, you're investing like VC. On the other hand, you have something that you buy that is liquid immediately, and most of all, active network participation, right? So you need to, if you don't stake, you're going to get inflated by up to 50-60% a year. So you can't just be passive capital. And especially what we're seeing now is that really one of the most important things for early stage DeFi protocols coming to now is that you actually provide liquidity, that you stake, that you do things as such, that you contribute. And this is in a lot of jurisdictions, a VC fund has big problems because the tax treatment is different for operational companies versus investment companies. So there can be funds that only have an investment mandate and they can't be operationally active, which sort of yield farming and all these things are. And then they fall into a different tax bracket. So it's very difficult for them to actively participate.
Oh, interesting. So what kind of classifications do you fall under?
So when you have a fund like ours with a very, very broad mandate, that is particularly offshore, then you don't have this classification. Are you an operational vehicle, or are you, are you just an investment vehicle?
Oh, okay.
Yeah.
Okay. Great. Okay. So tell me, we talked a little bit about this before, and I loved kind of your reasoning. So tell me about the name 1KX. What's behind it?
Yes, so a very typical VC question in sort of the traditional tech Web 2 kind of space was, is it 10 times better, faster, cheaper, right? So you're meeting an investor and they're like, and I think this is a very valid point. So for a normal user that has an app that's working and they've used it for 2 years, for them to switch to something that is better, it really needs to be 10 times better. So the question is it 10 times, is it a 10x? Is it 10 times faster, better, cheaper? And we actually think that the paradigm shift of crypto is so big that there will be some networks that are really 1,000x improvement over the status quo. And so this is why the firm is called 1KX.
Yeah, no, that's such a kind of bullish point of view on crypto. I'd love to have you kind of explain that further. Like, are we already seeing that? Like, are some of the services provided by Ethereum or Ethereum dApps, are they already, do you see them heading that way? Are they 1,000 times better already?
Yeah, so this is, I think, we had this conviction very, very early on, because when, like ourselves, we were very, very intimately involved in sort of Silicon Valley style venture building and company building. And, it's been dressed up very nicely as like, we want to make the world a better place, and we have nice mission statements. But really the playbook is that you subsidize a market takeover with venture capital funding, and you get to a natural monopoly. Or very, very strong technology lock-in / technology dependence. And this is very specifically, very surgically is how you design the dynamics of these VC companies. And this is exactly what VCs will look for. Can this become a natural monopoly? And when you get to that stage, can you then pretty much, extortion is a strong word, but what you're in a position is that you have a large number of people that are completely dependent on you, and you can basically dictate prices in any way you want, right? And you can become this sort of benevolent sort of kind of network to this really almost predatory kind of sort of extractor of value out of an ecosystem.
And is that what we're seeing like with Google, Facebook, Apple?
Exactly, right? And I would make the point that, for example, at this point, there is no publisher that voluntarily gives Facebook anything, right? At this point, it's pure sort of, it's just pure dependence. We cannot get around Facebook, we have to do it. I think this is with Facebook having like 90% market share, with Google having 90% something search market share, is very, very obvious, right? And then you can see that now Google is starting to push their own products ahead of other people, right? And so you just kind of have this, ultimately the dynamic is company versus customers or suppliers. It's just how it will end up in. And for us, the really, really big innovation in crypto is yes, it's technology, but it's a structural shift that you can now create token networks or software networks that have the best worlds of being open source, but also have these sort of economic / sort of capitalist incentives that, for individual upside, that attracts talents, that attracts entrepreneurs, but really gives you the design space to create a network and to create incentive structures that are more circular, that keep the value among all the participants, versus the typical company is, a board, a couple of founders, and then passive capital that is extracting all the value out of the network via dividends or, profit margins and dividends. What we like here is that you can actually redistribute that value that you're accruing entirely to every participant. And so in theory, these very, very powerful network effects that Silicon Valley style companies also have over the first few years, because they're reinvesting everything they have into the network, you can actually now continue this in theory forever in like a very virtuous cycle. So we do actually think that we might see some of these networks become bigger than any traditional company ever before.
That's so interesting. So I'd love to get more specific on this view. How exactly are these token crypto networks different from, for example, Google distributing shares among employees and just, you know, any user being able to own a piece of Google through a share? Is that not kind of like, you know, people being able to own a token in a network? Like, what's the specific difference that crypto is creating?
Yeah, so I think there's been, I think there's definitely been some thought around it. Airbnb was seeing, can we give the hosts some shares, right? Basically become the members of the network. I think there's a lot of friction around that. There've been some sort of, I would say, maybe benevolence attempts, but it hasn't really happened. I think, so we specifically, and we don't even see it necessarily ideologically even, we just see that for certain things, it's going to be really hard for a typical company to compete with these networks. And so there's really three specific reasons. And the first one is they're quasi better than free, right? You have, versus a company, I get paid, I have to pay every time I use it. And that the amount of I pay is really surgically sort of designed to be, you know, as much as possible in favor of the company. Whereas here you have a work/utility token, right? So quasi, when I have the token, it's almost for free to use the network. I might pay some gas fees, but their original reason of the gas fees is actually to prevent spam. It wasn't there to enrich anyone. Right. On top of that, those gas fees actually are straight one-to-one passed down to miners. They're not passed to, let's say, Ethereum, Vitalik, and his foundation in the middle, right? Right. At the same time, you now are a member of this digital cooperative. You have the token, right? That's your membership token / work access token. That might actually rise in value. Right? So now that's already better than free. On top of that, I think there's interesting experiments now with governance where you get to actually have some sense of sovereignty over the network and very, very important decisions. So I would say that this model is it's much better than free. And so this is sort of, you know, Amazon's your margin is my opportunity, really taken to the absolute structural maximum. So that's the first advantage. The second one is if you are a platform that requires a lot of innovation and experimentation on top, it's really impossible to compete with the sheer number of experiments with as a permission system. Right. So I'm Apple. I want to be king and gatekeeper to my platform. Every app that goes through has to be reviewed for 5 days. There's a lot of friction. And on top of that, I have this incentive to monetize that access, right? So I might get people who pay, preferential ad space, etc. That doesn't compete in the number of experiments that are running on Ethereum, right? Granted, from everything, from the good to the bad, but you know, I can be an extremely talented developer anywhere in the world with an internet connection, and I can build something and deploy it on Ethereum. And I don't need to negotiate. I don't need to go through review. And most of all, I can create something really, really crazy that an editor in an app store would just not understand and would say, no, probably, you know. So imagine, and this has kind of been said before, imagine where the internet was if AOL in the 90s decided what website would go live, right? Right. So this is the second advantage that these networks have, is that in terms of innovation, permissionless innovation really wins, and not because they're better or anything, it's just that the number of experiments that happen are just so much more. And you know, innovation is a numbers game. So the more experiments happen, the more likely you're really gonna, almost maybe by accident, discover something that is a truly unique new use case. For example, in the App Store, every 10,000 apps, one of them is successful, right? So it's just probability. You need a lot of experiments. And then the third one that, you know, private companies or public companies are going to have a really big time competing with is trust. So if you want to build a very, very large network, you need, you know, buy-in from users, suppliers, regulators, media, you know, people on the street, pretty much everyone. And trust in business has really steadily been declining over the last decades. People don't trust companies anymore. If you compare that to the 50s, 60s, you know, or a Ford, you know, or these large corporations where these sort of benevolent kind of like overlords and people were super excited and proud to work for, I think it's really started, especially with 2008, that faith in business itself really was shook and sort of started declining. And so we just see that these, you know, open, permissionless, ownerless networks that sort of belong to nobody, and because of that to everyone, they actually have a much better time at harnessing trust on a large scale from the bottom up. And I think the counterexample is you could see, you know, Facebook and how immediately regulators very aggressively stepped in against that.
Right.
Because
Yeah.
that's not really blockchain. It's actually a corporate kind of, it's a company coin.
Mm-hmm.
And you know, people don't trust companies anymore.
Right. And maybe the current environment we're living in now will accelerate that. Like people are trusting the system even less after, you know, what we've seen with COVID and Black Lives Matter and, you know, kind of the whole uprising against police brutality. All of that, I think, has people be more aware of how broken some institutions are.
Absolutely, and that this is sort of the part of our thesis is, or the thesis actually is that, you know, the cost of trust is massive. It's around 35% of GDP. 35% of the economy is just to establish trust. That's auditors, doesn't even work as with Wirecard. It's law enforcement, it's judges, and it's all these things. And so blockchains are inherently good at reducing that cost of trust almost down to zero. Because they themselves are open source sort of trusted systems, and they're trustable, and for the reasons that I explained before. On top of that, that market for trust is actually up for grabs, because it's not just trust in business that is declining. It's trust in the U.S. government is at historic lows. It's never been as low as now. Trust in every other institution as well, NGOs, media, right? NGOs, well, health organization, etc. So it's really in line with what you're saying. And COVID actually massively accelerated this trend, that the faith in most institutions that we have globally is really broken. And our thesis is that we actually invest in that mega trend, and that we think that some of these crypto networks are actually able to pick up that sort of market for trust.
So interesting. But so one thing here that I want to ask about is, so these mega corporations ruling the internet now, they were built on top of this open distributed protocol, which is the internet, but they were built as closed, centralized, for-profit businesses, because otherwise it's not sustainable to, you know, to build a social media company or to build a search engine. I mean, you need kind of incentives for people to stay building there, to the company to make money, and, you know, for it to work. Basically, that's why they're, you know, closed, centralized companies. And so what the big disruption with blockchain networks is that the token itself provides that incentive and allows these services to be open and permissionless, right? But I think there's still a question mark on how good these token-based business models really are. Like, we haven't really, I guess, like, it's too early to tell whether these applications and services can run on the long term with these token-based business models. So I'd like to get your thoughts on that. Like, what are some of the good token-based business models that you're seeing? Which do you think will be successful in the long term?
Yes, I think it's a very important point, and I think we have another way of looking at it is that we might not have definitive data yet on it saying yes, this is going to work for 100 years. On the other hand, we have over 100 years of data on the counter argument, which is companies and where it leads to. So that might help. On top of that, I think you are seeing, I think the most sustainable or the most long-term one is probably Ethereum, right? So where you had a distribution, 9% for team, 9% for the foundation, the rest was sort of, you know, sold to the community. And that has been going for, you know, over 5 years now. And I think the Ethereum Foundation at the peak had like 90 years of runway. I think they also sold pretty well at almost a peak. And so I think you have some early indicators that this is that this token incentive model can be sustainable. On the other side, what I also think something to consider is that these networks or these protocols, they're not supposed to be like companies and like for three founders to like fulfill their visions of self-actualization and be, you know, in power for like 100 years and run this empire, right? Networks are kind of, the idea is that actually they're protocols, and after a while they sort of are actually owned by the communities, by users, by suppliers, etc. You don't want to build sort of an empire and try to stay relevant for, you know, for 100 years. And me having not from the inside, but from the outside as a startup founder, been involved with larger corporations, I think few things I find more sad than these companies that know that they're going under and they're just desperately trying to stay relevant. And you have these strategy meetings where like, how we need to find, we need to reinvent ourselves. We need to and it's just like, I don't know. I think nature also has these cycles where things come, they were big, and then they die off, right? And you make space for new things. So I would also say that, it might also be okay that some of these protocols they're not determined to have 3 founders in the driver's seat for the next 50 years.
Okay. But still, you need that incentive to work, right? Like you need the token to appreciate somehow. So how do you get there?
Yes. So I think it is very, very simple. So you have a scarce asset, or you have an asset with sort of a predicted supply. So, even if it inflates for the next 10, 20 years, kind of, you have a limited supply. And now how do you have more demand than you have available free flow kind of tokens, right? And so I think we've learned, and this is also great about the space, everybody's learning together very quickly. I think really in 2017, there were a lot of people that really thought taco coin was going to be a thing. If I want to buy tacos, I have to pay a taco coin. And, the market for tacos is 30 billion every year. So this taco coin, the market cap should be 30 billion. Obviously in hindsight, that, kind of everybody's seeing how confused that was. And so if you just have a token that is essentially money and has a high velocity, which, by the way, Bitcoin and Ethereum actually still are this. Ethereum will change, but Bitcoin still is that. It's just a way to pay the miner, and then the miner sells it because he needs electricity. He needs to cover the cost for electricity. So it's actually a pretty terrible business model, or token model, sorry. Bitcoin has it as well, but it kind of convinced, or it kind of reinvented itself as like a hodl meme thing, like oh no, you hold it for the next 20 years, but the idea is that you have more demand for the core utility of that network, right? So the idea is it's not just investors who are buying this. This is actually people and other smart contracts that have demand for that functionality of the network. Therefore, they buy the token. And you have several sort of tactics or dynamics to actually take a lot of supply off the market. And proof of stake is a very simple one where you're taking a large part of the tokens off the market and you're staking them. And so instead of people spending money on mining rigs and electricity, people spend money directly and lock that up as collateral, right? And so that's, I think that's like in the simplest form is staking is essentially you just lock up a lot of supply for the token. Now, most proof of stake chains that are more recent and might be Ethereum killers haven't really found anyone that's buying their token for the demand yet, right? So that part they haven't figured out yet.
Right.
But in theory, that's this is the idea that you try to restrict supply. I think there's been more. I think the more recent investors in the space that are more sort of have a business background or finance background, they are starting to get excited about these, cash flow models where the protocol sort of extracts some fees, and then you can kind of value it in these more traditional senses with discounted cash flow models. And I'm kind of ambivalent about that because again, you don't want a small number of token holders to get into that same dynamic as with companies before, where you sort of becoming this distracted capital, right? You're just holding tokens. You haven't done anything. You're not participating in the network, but because there's maybe a fee and then a buy and burn or something, you just get rewarded simply for being capital that is passive.
Right. Is that what's going on, you think, with Maker?
Yeah, Maker has this model as well. I think some of the DeFi projects as well. I think there's not fees in there yet, but I think some of the people that are buying the token the governance token, are sort of hoping that governance tokens will allow them to vote in some fees.
Right.
And then they're back to the discounted cash flow models, right?
Right. So, okay, so that's basically Compound's token right now.
Yes, in theory, right? It's not, nobody knows if there ever will be fees voted in, but I think a lot of excitement around that is around that potential.
Okay, so and to you that could go into a slippery slope of going to the same model as like traditional corporations?
Potentially. So I would say it's not, given that we all need to go get to discounted cash flow models. I think it could potentially go down that route. And I think, especially in this space, it just invites you're going to get forked. Now, forking isn't as easy as it sounds. there is some sort of, switching costs for an ecosystem, maybe of integrations, etc., that used you.
Mm-hmm.
But if you're just adding fees, you're taking away. Again, it's always it's against your core incentives, right, of a user. If I'm a user, I prefer to pay no fees. It's really that simple. And so that's why I would say we maybe have some healthy skepticism around these kind of models, these fee models, whereas simply for the sake that we're seeing a lot of excitement around this, where it's sort of implied that it's going to go down that road.
Interesting. So to you, instead of having a platform that can add fees and generate demand for the token with that expectation that the token will be a way to access those fees, to you think a better business model would be one that, for example, incentivizes staking that token and have a use on the platform, increase demand for the token, and that will push up the value of the token,
Yes.
and therefore flow to investors that way rather than fees.
Yeah, I would say.
Okay, and then I want to ask you about your focus on Ethereum itself, because I've seen your thoughts on this before, and yeah, interested to know kind of what you think about Ethereum versus Ethereum killers. Isn't it kind of safer to maybe for an investor to diversify on different smart contract platforms, or why are you like 100% Ethereum focus?
So the first thing we saw in 2017 already was that you've had a lot of ICOs thinking that, okay, we're going to build this, and then they got to it and they realized, wow, there is some very essential tooling doesn't even exist yet. Okay, we're going to build it. We just raised 20 million, whatever, we'll just build it open source for the community. And so there's just a lot of like tooling and infrastructure that needs to be built on top of these protocols before it becomes accessible for even very good sort of developers, right? And I think this is easy to underestimate when you're not very technical in background. And on top of that, we are co-organizers of ETH Berlin. I think we've been to almost every Ethereum hackathon, since they started. And we really saw this incredible and very unique kind of developer community develop on top of Ethereum, and like really few others. And this is, again, coming back to sort of, VC landscape, what I was saying at the very beginning. In Tech 2, you need to be able to predict what individual application was going to win end consumer or enterprise adoption. And I think everybody's bad at this, so likely we're going to be even worse at this, right? or VCs are bad at this, so we're probably going to be even worse at this. What we were kind of pretty good at, or are good at, sort of understanding what developers are excited about. And this is, again, right, coming to the innovation part, how do a lot of experiments happen on top of a platform? And it was kind of pretty easy to see that Ethereum was really the one very early on. And it attracted a very specific type of engineer that is, really good engineers. They come in all shapes and sizes. They're from anywhere. You can't read them at MIT. And they're mainly intrinsically driven and motivated. And we just saw them sort of really get really excited and paying out of their own pocket tons of money, to fly to Singapore, participate in a hackathon, sleep kind of on the floor, like all these sacrifices. And so when you see something like that versus, EOS paying like some enterprise developer to pretend that they're hacking on something over a weekend, it was like so obvious, right? You're gonna run out of money eventually. But Ethereum had the opposite. You actually had people paying out of their own pocket just to participate in that.
Yeah.
And so it was really nice to see how this sort of evolved. And I think for us a very, very important moment was InstaDApp, because it meant the arrival of the UI layer. So we started that early, that it was all protocols, and if at the end of the day no entrepreneurs come in that are good at building UIs that allow you to interact with these protocols, we're still all doomed. And so this was a very, very great moment for us to see this team that I think they participated in ETH India or ETH Singapore build a beautiful UI to interact with sort of lending on Ethereum. anyways, and so we've seen this kind of Ethereum take the lead on there. We've taken very few sort of layer one investments outside of Ethereum. And I think I could see how these Ethereum killers, how that narrative was attractive. It was simple. So a lot of times, very simple investment narratives, they really worked surprisingly well. Right? So Ethereum is worth, at that time, was like 200 billion or something at the peak. Ethereum does 15 transactions per second, and some people were complaining that their CryptoKitty, was clogging up the network. So now, CryptoKitty should have never been on Ethereum. Like if I send something that's worth 50 cents, I don't really need a blockchain for that, right? So blockchains are really for high value transactions that need to be, with absolute security and guarantee. Anyway, so then come these people, impressive academic credentials. Like, look, Ethereum is worth 200 billion and does 15 transactions per second. We can do, 1,500 transactions per second. Hence, we should be worth more, like 100 times more. So that really worked. And for a lot of investors, I think the more recent ones that came in, it didn't really make sense to us that much because, again, we understood, like, once you have a developer ecosystem, it's extremely sticky. Once you have tooling infrastructure, it's extremely hard to port that over. In theory, you just copy it, EVM compatible, whatever, but it's just not the reality.
And of those applications and projects building on Ethereum, which are exciting to you? I especially considering what you mentioned before, that you prefer a model that doesn't add on fees and is not looking for this more like traditional cash flow model. So considering that, like, which applications fit this trend that you're looking for?
So I think obviously, or now it's kind of obvious that sort of, I think the space or the sector with the most product market fit is DeFi. We started investing in DeFi over a year ago. It was mainly because it fit very nicely within our token network thesis. And I guess we would say, as former sort of, real world software entrepreneurs, application layer entrepreneurs, we kind of understand like that we're very realistic about something getting usage from, whatever segment of users. And I think DeFi is great because you have around 200,000 people and around $2 billion that, you can, as a developer, as an entrepreneur, this is your first market you can tap into. Now, before my mom does a few taps on her phone and deposits something into, I don't know, Compound or Aave, I think that's still a little bit out, even though I think Arjun is doing a great job. And so I think, and a really good example is Nexus Mutual. So that was our first investment into DeFi. It was also, I think generally we like to invest in a way that we don't even have to be that smart to be successful. And so Nexus Mutual was a bit of an index investment, right? So no matter what wins, Compound, Aave, etc., a part of that value in these protocols is going to be insured on Nexus Mutual. So if the total value locked on Ethereum and DeFi grows, so does the contract sold on Nexus Mutual.
Right.
And Nexus Mutual has a token model. There's no fees in there. There's that sort of token holders take and sort of extract out of the system. You have stakers. They get part of the cover. When people buy insurance, 20 to 50% go to the stakers. So people who've absolved the risk and sort of identified those contracts as insurable, but also taking risks in case things go wrong. And the rest basically goes into the capital pool.
Right. And
so you really have this, the entire value of this network really accrues to the token holders and the participants.
Yeah, and you're right. I mean, if Ethereum and DeFi continues to grow as it has, you'll want more insurance. You'll have more demand to protect yourself. So.
Yeah, and you can see this. I think it's one of the strongest product market fits in the entire space. It's constantly sold out, right? So insurance mutual at the beginning is, it needs to be diversified. So you probably need around 25 different products that people buy equal amount of cover for. And then you sort of you can buy a lot of cover. Aave, Compound, Balancer, I think Curve, constantly are sold out. So people are constantly trying to buy more insurance than even is available. So I think that's a very, very bullish signal.
Right. What other big investment in DeFi have you made?
So that we're very excited about, one is Open, which is basically
Mm-hmm.
options sort of as a financial primitives. That's extremely exciting. Another one is FutureSwap, which is also extremely exciting. So I think, one of the biggest money centers in crypto are really, leverage trading, futures exchanges.
Mm-hmm.
I think they're honestly a terrible tax on the entire ecosystem. They are unregulated. I'm not a proponent of regulation, but it's basically nobody knows what's going on under the hood. BitMEX goes off at the worst of times, more or less convenient for them or not. There are other futures exchanges where the operator is trading their own book, right? They're insider trading. I mean, absolute red flag everywhere else. And so I think it's there's demand for it. It's a global audience that loves to do this. And at least, again, right, we think if we can create an open source, transparent token network where all of this value accrues to everyone who participates versus someone building a Shark Tank in the most expensive real estate in the world, office real estate in the world, then I think that's good for the ecosystem.
Right.
So I think that's FutureSwap is very, very exciting. Another project is Union. So that's an attempt at under-collateralized lending.
I don't know much about Union.
Yeah, so it's really interesting and something very new because at this point we're all over collateralized, right? Yeah. And so there's the criticism with that is that really just benefits people who already have a lot of assets that they can sort of put up as bond. And generally the tendency in the world is that you have few people with a lot of money and a lot of people who need capital, and they have access to that through credit. And we haven't really been able to map that on a blockchain yet. And so the way that Union does it is that you essentially have an underwriter ecosystem. So people that it could be, you have 3 friends that are vouching for you. So you stake, I think it was on one of the original yield farmers, it just hasn't been on mainnet yet, but you stake DAI into the Union. For that you receive a Union token. And then let's say I vouch for you for a certain amount of money and you have 2 other friends who do that as well, then you can completely under-collateralized borrow that money.
Oh, interesting.
And that seems like, very limited to, we're friends and we're vouching for each other, but it's really also, imagine someone that just analyzes Ethereum addresses and says, hey, this is, because you're incentivized if you borrow money after I vouch for you, that Union inflation reward that I get, it actually multiplies. So I'm incentivized to vouch for people that will also take the loan and pay it back. Right, so I could also see folks just analyzing Ethereum addresses and identifying patterns that would repay, and then maybe you send them a non-transferable NFT or token. And then should that address in the future ever apply for Union, I will automatically vouch for them. You could have communities, membership communities that have NFT tokens as part of the membership, and you can say, hey, everyone who has this NFT in their wallet, I will underwrite them as well. You could then, basically anything that any data that you have off-chain, right? I could still be a bank. So a bank could also tap into that. I think exchanges, maybe there are exchanges that have KYC data on folks and maybe some other transaction history, and they think for whatever reasons, they're creditworthy, they can also underwrite them. So it's very, general purpose, leaving it all up to an underwriter ecosystem. And I think that's a very exciting new step sort of for DeFi to take.
Yeah, it is exciting. I'm looking forward to seeing that play out. I think it is a kind of big missing piece in DeFi to have uncollateralized loans for sure. Because right now it's kind of mainly for a playground for whales, which I think it is okay in like the very early days, but we'll have to eventually move on, right?
Yes. And I think most markets actually have started out in the luxury segment, sort of in the upper market segment for wealthier people, and then have been made more accessible for the broader population. So I'm not criticizing DeFi, it's just for whales, done. No, it's actually, it's an amazing experimentation space. And if you really think about it, it's fantastic that we have. So when we were entrepreneurs in like mobile apps, it was really, really hard to get like the first 5,000-10,000 users that really cared about this. And even when it broke, that would go through the effort of giving feedback And most users, normal users, if something breaks, they just delete the app and that's it. They don't say a single thing. You just lost them and you never know why.
Mm-hmm.
And in DeFi, what's amazing, we have this large number of early adopters that is extremely keen and very risk tolerant, right? So imagine how much money people put into something just to try it out. And then if it breaks, they will definitely let you know, even if they complain, but that's a good thing. The problem is when people, they're upset, but they don't even say anything.
Right.
And so I think this is a really special area or community that we have at this moment. And I have a big confidence that, projects like Union and many more will further make that market way more accessible to a much larger sort of population.
You're right. Yeah, I think it's a great point that DeFi builders have, a huge, are benefiting so much from having an outspoken and like really active, hardcore community of users at this point, because everyone is really vocal about what's wrong and what's right, and because I think because of the tokens, you create this like highly engaged groups of people, that are active in like Discord and Twitter, and like from everything from like creating memes to like writing up like long threads. So it is a really special community. To wrap up, I always like to finish with kind of your big picture views on DeFi, crypto. I'd love to hear your thoughts on where DeFi is going in the long term. It might seem a little bit simplistic to ask this, but I still, like to get this out there on whether you think DeFi will end up replacing traditional finance because it is 1,000 times better, or will it end up, living beside it and kind of complementing it, or I don't know, a third option.
Yeah, so I think it will eventually completely replace it. I think it might take a long time. Something we're very realistic about is regulatory capture. And sort of, especially in the US, really since I think it's I forgot, Dwayne versus Wade is when really sort of, I would almost say, corruption in the US almost got institutionalized. It was that money is free speech and corporations are humans, and you can lobby unlimited amounts of money to politicians, right? And so the antitrust authorities in the US are completely toothless now, and are really, I think large corporations have completely captured the US political landscape. So I really don't underestimate this. At this point, they're still, I don't know, too distracted, or still think Bitcoin is stupid, and and they just heard of Bitcoin is stupid, and they're missing everything else. Now, I think a full-scale sort of regulatory attack on DeFi is, I don't think it's very likely, but something to kind of consider.
Yep.
But ultimately, I think over the long term, we have, we come from periods where you had a king and he would just come and whatever, take your horses and your wife, and that's it. And you couldn't do anything. And bit by bit over time, we've become more democratic. We have more access, more opportunity for everyone else. The world is slowly but surely becoming fairer, bit by bit. Right? It's maybe 3 steps forwards, 2 steps back. It's not always like linear, but I think we generally have this trend. And I think if you look at all the shenanigans that are basically happening with regulatory capture, if you look at these recent bailouts now, how much money was again given to corporations with almost no oversight, insights. So I think over the long run, things tend to get better. And this is very obvious, I think, for everyone who's been involved with crypto. It's very obvious to see how this is really, up to 1,000 times better. It really is.
Yeah.
And I think maybe it's a generational thing. I think, for someone who's grown up with crypto, it's going to be really hard to have any understanding for, this typical bank kind of terms and conditions of a loan or credit card statements where there's 20 pages of fine print that is literally printed in the tiniest font possible so that you are confused and you don't read it. I mean, right? When you grow up in a world where that is not normal, you just absolutely won't understand it anymore, and you will have zero tolerance for it. So I think it might be, in the worst case, really need millennials and kind of Zoomers to be in the driving force. But no way you're going to put up with this.
Yeah, no, I agree. I think, we're moving into a space where people just won't have patience for traditional finance anymore. Okay, so I love ending on this optimistic note for the future. Lasse, thank you so much for your time. This was really interesting conversation.
Thank you so much for having me. This was great.